In my last video, I showed you why America is in stage 3 of economic collapse. Over 2 million of you watched it. Thousands commented asking the same question. Okay, but what do I actually do about it? Today, I'm going to answer that question with 500 years of hard data. I analyzed every major currency collapse in modern history. Spain, 1557, Dutch Republic, 1795, Britain, 1976, Weimar Germany, 1923, Zimbabwe, 2008, Venezuela, 2018. And I tracked what happened to every major asset class during each collapse. Which assets preserved wealth? Which ones multiplied it, and which ones completely destroyed the people who held them? By the end of this video, you'll know exactly what worked, what failed, and what you should be doing right now while you still have time. Because here's the brutal truth. In every single collapse, 90% of people held the wrong assets, and they lost everything. The 10% who survived? They saw the pattern and positioned accordingly. Let's make sure you're in that 10%. Before we dive into the specific assets, you need to understand the framework. During currency collapse, all assets fall into one of 3 categories. Category 1, value destroyers. These are assets denominated in the collapsing currency. Cash, bonds, fixed annuities, pensions, anything that promises to pay you a fixed amount in the dying currency. In every collapse, these go to zero or near zero in real purchasing power terms. Category 2, value preservers. These are hard assets that maintain purchasing power across currency transitions. They don't make you rich, but they protect what you have. This is survival mode. This is how the middle class stays middle class instead of becoming poor. Category 3, value multipliers. These are strategic assets that actually increase in relative value during the chaos. This is how the wealthy get wealthier during collapse. This is how generational wealth transfers happen. Today, we're focusing on categories 2 and 3, the assets that either preserve or multiply wealth. Because if you're watching this video, you're already ahead of the 90% who don't even know these categories exist. Let's start with the single most important asset class in history. Asset number 1, gold and precious metals. And before you roll your eyes thinking that's obvious, let me show you data that will change how you think about gold forever. Spain, 1557 to 1600. When Spain defaulted in 1557, the Spanish real lost 87% of its purchasing power over the next 40 years. If you held 1,000 reals in cash, by 1600 you could buy what 130 reals bought in 1557. Your wealth was destroyed. But gold. 1 ounce of gold in 1557 bought approximately 8.5 reals. By 1600, that same ounce bought 65 reals. Gold didn't just preserve wealth. It multiplied purchasing power by 7.6 times as the currency collapsed. Why? Because the government kept debasing the currency, minting more reals from the same amount of precious metal. And here's the critical detail. The people who saw it coming, the Fugger banking family, the Genoese merchants, they converted to gold and silver before the default started. By 1555, they were demanding repayment in specie, in actual metal, not promises. They knew. The Dutch Republic, 1795. The guilder collapsed when French armies invaded. In 1790, 1 guilder of silver bought X amount of goods. By 1800, that same silver guilder bought 4.3 times more in devalued paper guilder terms. But here's what's fascinating. The Bank of Amsterdam had been secretly operating fractional reserve banking since 1672. They claimed to hold 100% metal backing for deposits. They didn't. By 1795, they held less than 10% backing. When the fraud was exposed, depositors who held paper claims lost 90% plus. Depositors who had taken physical delivery of gold and silver, they were fine. They survived. Britain, 1931 to 1976. Britain left the gold standard in 1931. The pound lost 87% of its purchasing power against gold between 1931 and 1976. But this one's even more instructive because we have detailed data. In 1931, the pound traded at $4.86 USD. Gold was $20.67 per ounce. By 1976, the pound had fallen to $1.75 USD. Gold was $125 per ounce. If you held 1,000 pounds in cash from 1931 to 1976, your nominal value, still 1,000 pounds. Your real purchasing power, down 85%, you're devastated. If you held 1,000 pounds worth of gold in 1931, about 48 ounces. By 1976, that gold sold for 6,000 pounds, plus in pound terms. Your purchasing power increased 6 times. You survived and thrived. Across all 3 collapses, Spain, Dutch Republic, Britain, gold and precious metals maintained or increased purchasing power. The average gain was 5 to 7 times in real terms as the currencies devalued. But here's the critical lesson. The people who profited weren't the ones who bought gold during the collapse. They were the ones who bought before, during stage 3, during the silent exodus, when smart money was repositioning. In Spain, the thuggers converted 1553 to 1555 before the 1557 default. In Amsterdam, informed merchants moved 1690 to 1693 before the 1795 collapse. In Britain, wealthy families bought gold 1930 to 1931 before the pound collapsed. They bought when everyone else thought they were crazy. And they survived. Modern application. We're in stage 3 right now. China and Russia have been accumulating gold aggressively. China's official reserves increased from 1,054 tons in 2015 to over 2,260 tons today. Russia went from 1,039 tons in 2015 to over 2,330 tons before sanctions hit. Central banks globally added 1,136 tons of gold in 2022, the highest annual purchase in 55 years. They're not doing this randomly. They see the same pattern you just learned. Practical guidance. For gold, 10 to 20% of liquid portfolio. Physical gold, coins, bars, held outside the banking system. Not paper gold, not ETFs that promise delivery. Actual metal you can hold. For silver, 5 to 10% of portfolio. Silver is more volatile, but historically outperforms gold in percentage terms during currency crisis, though with higher volatility. Other precious metals, platinum, palladium, 0 to 5%. More industrial exposure, less pure monetary hedge. The mechanism. Gold preserves wealth because governments can't print it. There's no central bank of gold. No politician can decree more gold into existence. Its supply grows approximately 1.5% per year from mining, far less than fiat currency printing. And in every collapse, when people lose faith in paper, they return to metal. It's happened for 5,000 years. It'll happen again. Asset number 2. Productive real estate and agricultural land. Notice I said productive. This distinction matters more than you think. The critical distinction. Not all real estate survives currency collapse. Speculative real estate, vacation homes, luxury condos, commercial office space in declining cities. These often collapse in value. But productive real estate, farmland, rental properties in essential areas, industrial facilities producing necessary goods. These not only survive, they often appreciate. Why? Because they produce income or food or essential goods regardless of what happens to the currency. A farm produces food whether you're paying in dollars, pounds, or chickens. Rental housing provides shelter whether the currency is gold or paper. Spain, 1550s to 1600s. Here's data that surprised even me. Agricultural land in productive regions of Spain, Castile, Andalusia increased in value by 3.2 times in real terms between 1550s and 1600s, even as the currency collapsed. How do we know this? Through property transfer records maintained by the Catholic Church and Spanish nobility. They recorded sales in both monetary terms and in kind. Bushels of wheat, barrels of wine. A property that sold for 1,000 reals in 1550 sold for 8,500 reals in 1600, an 8.5 times increase. But remember, the currency lost 87% of purchasing power. So in real terms, adjusted for debasement, that's a 3.2 times gain. Meanwhile, speculative property in Madrid, townhouses, commercial buildings, many lost value in real terms as the economy contracted and people fled the capital. The key lesson: land that produces food survived. Land that exists for speculation didn't. The Dutch Republic, 1650 to 1795. The Dutch had the most sophisticated land market in the world. We have incredible data. Productive agricultural land in Friesland and Holland provinces increased 4.7 times in real terms between 1650 and 1795. How? Because as the guilder devalued, farmland prices rose in nominal terms faster than inflation. But here's the mechanism. Dutch landowners leased farms under contracts that allowed rent adjustments. As currency devalued, they raised rents in nominal terms. The land threw off income that adjusted for inflation. It was a natural hedge. Urban rental properties in Amsterdam appreciated 3.1 times in real terms during the same period. Again, because rents could adjust as the currency weakened. Compare this to guilder-denominated bonds. Total wipeout. The Dutch government defaulted multiple times. Bondholders lost 80 to 95%. Britain, 1920 to 1976. This is where we have the most detailed data, because modern records exist. British farmland increased from an average of £20 per acre in 1920 to £485 per acre by 1976, a 24 times increase nominally. Adjusted for pound devaluation, that's still a 4.2 times real gain. But here's what's fascinating. Not all land appreciated equally. Productive farmland in East Anglia, the Midlands, productive regions, big gains. Marginal land in Scotland, Wales, declining industrial areas, minimal gains or losses. The pattern, productive capacity determines survival. Rental properties in London increased 18 times nominally, 3.8 times in real terms. Why? Because Britain was urbanizing. People needed housing. Landlords could raise rents as the pound devalued. The mechanism: real estate survives currency collapse for 3 reasons. 1. It's a hard asset. You can't print land. Supply is fixed. 2. It produces income that adjusts for inflation. Rents can rise. Farm yields can be sold for more devalued currency. 3. It satisfies basic needs. People need food and shelter, regardless of economic conditions. But here are the risks. 1. Property taxes can become confiscatory. Governments in crisis raise taxes on visible assets. In Britain during the 1970s, some landowners paid 83% marginal tax rates. 2. Location matters enormously. Productive regions appreciate. Declining regions collapse. 3. Liquidity is terrible during crisis. You can't sell farmland quickly when you need cash. This nearly destroyed many British landowners in the 1930s who were asset-rich but cash-poor. Modern application, we're seeing the pattern repeat. Farmland prices in the U.S. increased 13.7% in 2022, 7.4% in 2023, far above general inflation. Why? Smart money sees the same pattern. Bill Gates now owns 268,984 acres of U.S. farmland. Why would a tech billionaire buy farms? Because he can read history. Practical guidance. For most people, 5 to 15% of portfolio in real estate. Priorities. Productive farmland in stable regions. Midwest U.S., agricultural Canada, select international. Essential rental housing, workforce housing in economically stable areas. Industrial facilities producing necessities. Water, power, food processing. Avoid speculative luxury properties, commercial office in declining cities, vacation homes in unstable regions, anything in jurisdictions with confiscatory tax potential. The timing. The British landowners who profited most bought between 1920 to 1935, during the quiet period before the pound's final collapse. They bought when land was cheap because everyone was pessimistic. The time to buy productive real estate is stage 3, when smart money is repositioning but before the crowd panics. That's now. Asset number 3, productive businesses and equity in essential companies. This is the most misunderstood asset class during collapse. So pay attention. The paradox. Stock markets often crash during currency collapse. Spain's merchant trading companies, Dutch East India Company stock after 1795, British equities in the 1970s. So how is equity a survivor asset? The answer, you need to distinguish between the stock market and productive businesses. The critical distinction, the stock market is a popularity contest driven by sentiment. Productive businesses are cash-generating machines. During currency collapse, the market crashes, but certain businesses, the ones producing necessities, not only survive, they thrive. Weimar Germany, 1918 to 1923. This is the best documented hyperinflation in history, so we have incredible data. If you held German marks in cash from 1918 to 1923, you lost 99.999999% of purchasing power. Complete wipeout. If you held German government bonds, same result, destroyed. But if you held equity in German industrial companies, specifically companies producing necessities, you not only survived, you profited enormously. Example. A share of Daimler-Benz in January 1918 cost 800 marks. By November 1923, it traded at 38 trillion marks. 38 trillion. Sounds impressive until you realize a loaf of bread cost 428 trillion marks. But here's the key. If you bought that share in January 1918 for 800 marks, which could buy 400 loaves of bread, and sold it in November 1923 for 38 trillion marks, which bought 88,000 loaves of bread, your purchasing power increased 220 times. The company produced cars. People needed transportation regardless of currency chaos. The business adjusted prices for hyperinflation. Shareholders captured that value. Meanwhile, companies dependent on credit or government contracts, banks, utilities, insurers, were destroyed. The pattern. Across history. Spain, 1550 to 1600. Merchant companies with hard goods inventory, textiles, metals, food, outperformed. Companies dependent on credit or royal contracts collapsed. Dutch Republic, 1650 to 1795. The Dutch East India Company collapsed spectacularly, but that was because it was overleveraged and dependent on government monopoly grants. Independent merchants with physical trade goods, spices, timber, grain, preserved wealth. Britain, 1920 to 1976. Shares in essential goods companies, food processing, basic manufacturing, utilities, appreciated 6 to 8 times in real terms. Financial companies, luxury goods, discretionary sectors, destroyed. The mechanism. Businesses survive currency collapse when they have 3 characteristics. 1. They produce essential goods or services: food, water, energy, basic transportation, healthcare, basic communication. 2. They can raise prices in nominal terms as the currency devalues. Pricing power is everything. 3. They have low debt. Debt becomes a death sentence during currency collapse as interest rates spike and credit freezes. The risks. 1. Government confiscation or nationalization. During crisis, governments seize essential businesses. British government nationalized coal, steel, healthcare, railways in the 1940s to 50s. 2. Price controls. Governments often impose price controls on essentials, destroying profit margins. 3. The stock market itself can close or freeze during extreme crisis. This happened in Spain, Germany, and multiple times in modern collapses. Modern application. We're seeing the pattern. Companies producing food, water, energy are outperforming. Tech stocks, luxury goods, financials are vulnerable. Practical guidance. For equity exposure, 10 to 25% of portfolio. Focus on agricultural companies, food production, processing, distribution. Water utilities, essential service, monopoly positions. Energy producers, oil, gas, nuclear, not speculative renewables. Basic materials, copper, iron, industrial metals. Defense contractors, governments keep paying them even in crisis. Avoid high-debt companies, death sentence in crisis. Luxury goods, first thing consumers cut. Financials, destroyed in every collapse. Companies dependent on government subsidies, anything speculative or dependent on cheap credit. And here's the critical point. The time to buy these businesses is not during the collapse, it's before, when they're undervalued because everyone's chasing growth stocks and crypto and meme stocks. The British investors who profited most bought essential goods companies in 1925 to 1935, when they were boring and cheap. By 1976, those boring companies had preserved and multiplied wealth. We're in that window now. Now let me quickly tell you what to avoid, the value destroyers that wiped out 90% of people in every collapse. 1. Cash and cash equivalents. Checking accounts, savings accounts, money market funds. If it's denominated in the collapsing currency and sits in a bank, it's getting destroyed. In Weimar Germany, 1 trillion marks in a savings account became worthless. In Zimbabwe, $100 trillion bought 3 eggs. Don't be the person holding cash. 2. Government bonds. Every single collapse saw government debt default or inflate away to nothing. Spanish bonds, defaulted 4 times. Dutch bonds, worthless after French invasion. British gilts, lost 87% real value. Venezuelan bonds, trading at 3 cents on the dollar. The pattern is perfect. Government bonds in a collapsing currency are financial suicide. 3. Fixed annuities and pensions. These promise to pay you fixed amounts in the dying currency. Weimar Germany destroyed an entire generation of retirees who had saved in marks their whole lives. British pensioners saw purchasing power evaporate. If your retirement depends on promises to pay you fixed dollars, you're exposed. 4. Most corporate bonds. Same problem as government bonds. They promise fixed payments in devaluing currency. Plus, corporate defaults spike during crisis. Double death. 5. Speculative assets dependent on cheap credit. Crypto that's not Bitcoin, meme stocks, SPACs, NFTs, anything that exists purely because interest rates were zero. When credit tightens and currencies collapse, speculative excess dies first. The 90% who got destroyed held these assets. Don't be them. Let me bring this home. 3 asset classes survived every currency collapse in 500 years. Gold and precious metals averaged 5 to 7 times real gains. Productive real estate averaged 4 times real gains. Essential businesses averaged 6 to 8 times real gains when chosen correctly. The 10% who survived and thrived held these assets before the collapse hit during Stage 3, when everyone else thought they were paranoid. We're in Stage 3 right now. Foreign central banks are selling treasuries. Major institutions are diversifying. The smart money is repositioning. You have the same data they have. You know the same pattern they know. The only question is whether you'll act on it. My recommended allocation based on historical survival rates. 10 to 20% precious metals, mostly gold. 5 to 15% productive real estate. 10 to 25% equity in essential businesses. Remaining, strategic liquidity and skills. That's 25 to 60% of your portfolio in survivor assets. The rest gives you flexibility and options. Drop a comment. What percentage of your portfolio is in survivor assets right now? Let's see where everyone stands. Next video. I'm breaking down the exact timeline for Stage 4. When it starts, how fast it moves, what the trigger events look like based on historical precedent. You'll know exactly what to watch for. Subscribe and hit the bell. Share this with anyone who needs to see it. The pattern repeats. The cycle continues. The 10% who see it coming survive. Make sure you're in that 10%. Thanks for watching.